quiet. Good afternoon, everybody. Can you hear me? Yeah. Great. So, well, gosh, thank you so much for staying on. I know it's the last session after an amazing 2 days at AFSIC, and I'm sure, as one of my panelists said, your brains are fried. But we hope to have a very lively discussion, and the topic of this session is financing Africa's climate agenda, innovative instruments and structure. So I'd like to welcome my panelists. So please be seated. Thank you. Great, thank you. I don't know how many of you attended or witnessed what happened in Nairobi at the Africa Climate Summit. I must say I had the privilege of being there, and it was just amazing. I mean, it was typical, the African village with a lot of dynamic conversations, lots of great ideas, and lots of great pronouncements around the opportunities that the global climate agenda represents for the African continent. So our topic today is really how do we begin to finance those opportunities? The statistics tell us that only 14% of climate finance is coming from the private sector. However, we have at least 2 trillion of assets under management between the sovereign wealth funds, the pension funds, and the institutional investors. And so how do we build the conduits? How do we build the instruments? How do we drive finance in order to capture the opportunity that the continent offers to contribute to achieving our targets, our global targets on CO2 emissions? And we are starting from a point of the fact that we have amazing human capital, a very youthful population. We have abundant natural capital, as you heard from the previous panel. And we have the real opportunity to leapfrog our financial sector and also to leapfrog our economic growth into a green-powered economic growth. So it is just really an opportune time for us to be talking about what role does the financial sector play in ensuring that we can drive that finance to where it's needed. So today on this panel, we have a group of actually 3 of our portfolio companies. I have to admit, so FSD Africa Investments were funded by the UK government through FCDO, and our purpose is to finance and catalyze, so to provide that risk capital to catalyze those innovations in climate finance. So I'm delighted to say that we have backed a number of very innovative players in the market whom I'll introduce shortly. And then we have a colleague from EY who's with us who's done a number of interesting transactions, particularly in the blue economy space, but also in sustainable finance, who will give us sort of a cross-cutting view on what the risks are and what the opportunities are. So without further ado, let me just introduce our panelists and sort of give you a picture of the spectrum in which we need to be thinking about innovation. So from a capital markets perspective, CHINUA here is the CEO of InfraCredit. And so he'll give us a perspective of how you can be quite innovative with kind of tailoring existing capital markets instruments in order to drive both local capital and international capital, particularly into the green infrastructure space. The other spectrum of the financing landscape is how do you drive more finance to our youth population? Those are the ones that are really innovating and going to drive that leapfrogging. And we all know that SMEs on the continent are the backbone of our economies. So we have MAELIS and WAIRIMU both running venture funds that are specifically targeting climate adaptation and climate mitigation early stage companies. So we've got two spectrums, you know, from the SMEs, and then how do we deepen our capital markets, and what are the innovations that we have in that space? So, CHINUA, I'm going to start with you. So, in 2 words, just tell us what InfraCredit does from a capital markets perspective. And then tell us a little bit about how we've tweaked existing instruments, like guarantees, to help mobilize more local capital. So where's the innovation coming from there?
Thank you. Good evening, everyone. It's a pleasure to be here. So InfraCredit was conceptualized by the Nigerian Sovereign Investment Authority alongside its development partner, the Private Infrastructure Development Group, with a mission to create a local credit enhancement facility that can provide credit guarantees and improve the quality and address the perception of risk for infrastructure projects, thereby mobilizing domestic resources from pensions and insurance to invest in these asset classes, thereby creating a new asset class. So when we issue these guarantees, we create long-term corporate infrastructure debt instruments that are issued in the capital markets, thereby deepening the market for a new asset class for these institutional investors. Essentially, like many certain African countries, Nigeria has fast-growing pension fund, youthful population, but not enough projects are being unlocked as an asset on their portfolio. They invest largely in sovereign instruments. And so our role is to help to enhance these assets, create our rating, essentially improve the creditworthiness of the projects, thereby enabling more long-term local currency capital allocation coming from these domestic institutional investors. And so to your earlier point around when we think about the fact that we have up to 2 trillion of assets under management, whether with the pensions, sovereign wealth funds, and insurance companies, this is one of the sort of solutions, the local solutions that had been developed to sort of address that gap. We've been able to essentially help, since our existence, issue these credit enhancements to unlock financing in tenors of up to 20 years. So prior to InfraCredit's existence, term debt was around 7 years in the capital markets. With our guarantees, we enabled to lengthen the tenor of borrowings for projects such as off-grid energy access, telecommunications projects, transportation, companies, to raise financing of tenors of up to, we've done 10, 15, and very recently we supported a 20-year financing, which was largely subscribed by domestic institutional investors. So essentially, it is possible, especially because we have a youthful population. So when you look at the maturity cycle for these retirement savings is long, because the average age, 75% of the population is less than 35 years. So you can see that there is sufficient pool of capital that can go in. It grows at about 15% per annum, right? So there is a huge opportunity to unlock this asset class. So to date, we've been able to support, depend on the exchange rate, about up to $400 million Naira equivalent of financing in corporate debt instruments. But to really have broader impact, we found that we needed to work across other tools and partners. And this looks at areas such as blended finance, where we work with other development partners that have capital that can, provide subordinated first loss, capital to reduce the cost of financing for certain high-impact projects, but also risk-sharing instruments, such as the product we developed co-finance with FSD Africa, which is like a risk-sharing backstop facility that can help us to address access to capital for climate-aligned infrastructure. So like any other infra project, even climate assets will struggle with the perception of risk. And so how do we address that in a way that enables us to prove that the assets are not as risky as they're perceived to be? And over time, we've demonstrated this. We've provided guarantees for projects that raise capital in the first instance from pensions with guarantees, and subsequently didn't need guarantees again because of the performance of that asset and the perception of risk being addressed because of investors seeing that it's not as risky as it appears. And so we're seeing that structure can be replicated as well when we pull in different tools. And it's really a case of how we work as an ecosystem, as you highlighted, because there are different funding needs in the capital stack, from equity to debt and to senior debt as well, but also technical assistance tools that can help to improve the quality of the preparation of the projects as well. So we're seeing that these instruments need to work in alignment to create this sort of cycle, and that is de-risking in itself because it improves the quality of projects. It provides the data that investors need to see to get comfortable, so we can actually be able to mobilize what we call from billions to trillions, because then you have more leverage that you can actually achieve with your guarantees, because investors feel more confident to take more risk and with limited amount of support from instruments like ours. So so in terms of the innovation is really, for us, it's really looking at the fact that project development and early stage financing is much needed, and the tools needed for that we are collaborating around with support from institutions like FSD Africa. But also that there's a lot of work that goes into capacity building, just alongside building knowledge along as we do projects, as we exchange knowledge and more information. That also helps reduce the perception of risk.
Great, no, thank you. So really a great example about using instruments that are available in the market, like guarantees and bonds, but trying to figure out what are the pain points and how do you apply these in a way that there's a better alignment of incentives, that there is a capacity building, and that you're leveraging local capital. And then in the guarantee sort of risk instrument that we designed, because it involved, in essence, three parties, us as the guarantee, InfraCredit as the vetter, and then the banks as providing the credit, you're really trying to kind of put a circle around the incentives in order, for the banks to begin to participate in providing the financing. And at the back of the Paris summit, when there's this huge call for private capital into Africa in order to address its 300 billion annual requirements of finance, and a lot of the discussion was about how can we do guarantees better? So that was a big sort of recommendation. We need to do guarantees better, and we're testing that. But secondly, how do you deal with Forex hedging? And I know, one of the solutions is actually to mobilize local capital. And really, how do you create some of those innovations that's going to drive the local capital? So watch this space. We're hoping to see InfraCredit expand into other markets. I'm going to turn to our venture ladies. So MAELIS, let me start with you. And so just tell us a little bit about what you think is the innovation that you are bringing to the table from a venture finance perspective.
Sure, great question. And I think there's really two innovations. So as you said, currently across the continent, there's a huge financing gap for climate tech solutions in general. It is estimated that is basically in the north of $1 trillion, as you mentioned. And in particular, the gap for adaptation and resilience solutions is even greater. So if it's 14% of private capital that goes to climate solutions globally, that's only 2% for adaptation. And the estimate is that we'll need $578 billion between now and 2030. So we decided with our venture funds to really focus on filling that gap, because we really believe fundamentally that every sector of the economy will have to adapt to climate change impacts. And we're already beyond a scenario where we'll be able to stay below 1.5 degree warming. So we'll have to think creatively about how do we enable sectors to adapt as we promote green growth, as you were saying, and capture the opportunities that really work for the continent, for communities in Africa, with the vulnerabilities that are really idiosyncratic or applicable to each different country and region within the continent itself, because obviously it varies. So we decided to tackle that that's innovative in and of itself, but the way we tackle it is also unique. So we're a pre-seed venture fund, but we invest not just capital, but also human capital. So when we back companies at the earliest stage of their journeys, we basically match our investment cash in the company, right, our capital in, with support from a team of operators who become basically your interim CMO, interim CTO, your head of product, head of sales, head of growth, fundraising, all the core functions of an early stage startup, and help them overcome the early challenges, right, of a growing but scrappy pre-seed company, because obviously oftentimes, really actually in all the cases, you don't have enough resources to secure, right, that talent in the team, and you need to figure out how to get to the proof point so that you reach milestones, and then other follow-on investors can come and further finance your company. So that's what we call venture building, and we've priced it into our equity ticket so that we can really work alongside the founders for 7 months and become basically co-founders for that period, and then can continue to back the best at seed and Series A with, at that point, just capital, right? So we do finance the journey between pre-seed and Series A, but I think the human capital piece is really essential, and it has to be done right? It's not cookie cutter, it's not an accelerator that does workshops, and it's all the same for everybody. It's really bespoke to the needs of the founders, and that for me was critical because I was a startup founder myself before, and unless something is really targeted to your needs in that point in time, right place, basically, it's not as helpful in really facilitating your growth. So that's how we're trying to tackle that issue, to make sure we, across various sectors, build strong, climate-smart innovations, place early bets, grow them to a point that they're really providing services that can scale, right, as we're talking this morning, and attract further financing, and do that by working on the early issues that founders typically face across the continent.
Give us an example of the kinds of businesses that you are supporting.
Absolutely. Well, one of them was on stage earlier, Octavia Carbon, so I won't talk about them. But two examples. So one company we backed is in Morocco. It's called Sand to Green, and they're literally turning desert land into arable land by essentially building these modular, low-cost desalination machines that are able to extract water from, it's brackish water, so from deep soil, not from the oceans. And then they have a drip irrigation systems in the plantation, and they use agroforestry techniques, so a nature-based solution to really restore the soils and work with farmers, but this is a bit larger scale farms, to produce, obviously better, and then also on the back of restoring soils, sell carbon credits. And that's been a very, very successful business that already raised $2 million. So they're growing really quickly. And we also invested, for example, in an agtech platform in Nigeria that's really trying to connect sort of off-takers, financial service providers, and the farmers with a digital approach, but sort of vertically integrated. Or an insurance company in Senegal that's really working in integrating climate risk, which is obviously has also a reinsurance partner, into a digital insurance for the underserved. So how do you actually work with an agent model, but also a digital platform that can scale to reach people that never had insurance before, and integrate risk of flooding, risk of earthquakes, or other disasters that are much more common in Senegal.
And you're finding that there's lots of opportunity or not?
So that's one of the barriers we are there to fill, is this sentiment, which I think is true, that there's a lack of pipeline and bankable projects in this space in general. So as I said, we want to place early bets in many companies and work alongside them to really build them to be strong, scalable businesses. But we are finding opportunity, much more actually in the past 12 months. So we started investing in January 2022. And at that time, it was a lot scarcer, and now we're already seeing much more diversity in the type of businesses that are tackling these issues. It used to be very, for example, agri-heavy. Now there's diversity. We're seeing things in water management, water access. We're seeing innovations definitely in the sustainable energy space, but also on cold chain, climate data solutions, like Amini, for example, in East Africa, really tackling data, like infrastructure issues. And that's, the sort of innovations that we think is going to continue to grow in the years to come.
Great, thank you. WAIRIMU, tell us about Persistent and what are you innovating there?
All right. Much like MAELIS and Catalyst Fund, we are a venture builder. We've actually been doing it for the last 10 years off of our balance sheet. So we have a 10-year track record in venture building. Have invested in 23 companies in 22 countries in Africa. And what we found in our venture building is, and I'm sure you've all seen that, is that especially with African founders who we support a lot, they need that support. They need that venture building support. And there's no ecosystem much like we have in Silicon Valley where you can get a cheap CFO or a CLO or just someone who can come in and have a little bit of incentive equity and they're able to do the work and wait for a payout later. And that's also what we do, where we come in with a financial investment and come in with human capital. So in terms of how we've innovated over the years in our venture building is we've recognized that it's not just enough to say provide an interim CFO, that we need to make our products even more bespoke depending on the startups that we come with. So during our screening, during our due diligence, we will identify the areas where there are gaps in the company. So we've seen that sometimes there are more gaps that they need in their financial processes. Sometimes you have a founder who is so busy, bootstrapping that they've not, had audited accounts over the, last year. So we wouldn't see that as a gap. We wouldn't see that as a reason why we shouldn't invest. We'll just say, okay, this is a gap that we've seen. Or in compliance and ESG, a lot of the companies that you find, maybe they're, again, too busy trying to make the business work, that they've not done tax filings. Again, that's a learning for the company and a learning for us. And so we've been able to have bespoke venture building in financial, in legal compliance and ESG. In technology, we have a dedicated tech venture building team that helps the companies develop their products, their apps, and how they use their tech. In fundraising, and in fundraising, aside from the finance function, another innovation we've done is leveraging off of our partnerships, off of our investors as well, where we've had co-investment opportunities, where we've presented to our shareholders and also other players in the market, and in strategic support. And some of the strategic support that we've had is, for instance, again, we've got a company set up, they don't have board rules, they don't have governance rules, so we've been able to help them set those up. And another innovation that we, again, have seen as a need over the years is having, for our investment teams and for our venture teams, team members on the ground in the countries that we are operating. So as Persistent, we've got 2 main offices in Africa. We've got Nairobi, where we've got 13 staff, and Nigeria, where we've got 4 staff. And then we've got venture builders based in the DRC. So our venture builder in the DRC actually sits with Altec in Goma. We've got venture builders based in Senegal, looking at Francophone Africa, and in Uganda. And with that, we find that it's easy to have that hands-on approach in having conversations with our founders and in making sure we're getting the right companies to invest in and to venture build and hopefully get them past the hurdles that they need to pass due diligence in Series A, in Series B. And we've been fortunate that some of our successful companies include Altec in the DRC, which is seen as a difficult market even now. But Altec is co-founded by 2 Congolese nationals. They have, through our venture building over the past 2 years, been able to raise, I think, $30 million in debt and a few grants. And that just shows that with the right approach and with the learning from the founders, you can really be able to make a difference. And they've been able to expand their operations now in 23 out of 26 provinces in the DRC.
So can you give us examples of some of the funds, and then tell us a little bit about the exits that you've been able to achieve?
All right.
Because that's a huge topic. You know. Can you do these exits?
We can do exits. Obviously, you know, it's been tough, especially in climate the past few years, but what we've seen is that the companies that we were able to provide support to in the early days have actually grown to succeed, and we've managed to have realized exits. The latest exit that we had was from Daystar Power. Daystar is a Nigerian CNI, commercial and industrial solar company, and we exited along with various investors, including DFIs, to Shell Corporate. And for us, for Persistent, that was about a 2.8x multiple for a company that we had supported earlier in their growth journey. So we can see that as a value in venture building. Another exit that we had, again, last year in 2022 was in a marketplace company called Sabi, and they were a spin-off from RenSource, which is a commercial and industrial solar company in Nigeria. And again, we were able to realize actually quite a profitable exit. That was a 7.8x multiple.
Wow.
Again, through the development of technology in Africa, it's a hot product. And there are other exits, two other more exits that we've done. One with a 2.3x multiple. Phoenix, we exited in 2018 to Onji, and as well as Zola, we exited, I believe, at a 1.8x multiple. So there are, you know, and that was in 2013. But we can clearly see, and in terms of even our portfolio, when we look at our portfolio, our best performers are companies that we venture build. I've talked about Altec. There's Kandi Solar, which is a commercial industrial solar company based in South Africa. Actually, for that, we had venture builders who then moved to the company in order to achieve the success. We've developed that relationship further. Tobias, our managing partner, is a board member in Kandi, and they've been able to move on, and I believe they're now planning their Series C fundraise.
So that's really, I mean, just an amazing story. So Chris, I'm going to come to you. So we've got venture builders that say that bankable projects are not the issue. We can do exits. We've got these capital markets instruments. So what's this whole thing about risk? Right? Why does everybody say there's too much risk on the continent and there's no bankable projects?
Well, I think it's very interesting to listen to my co-panelists. It speaks to an ecosystem with a value chain. And I think in the most recent years, I've been working extensively more in the infrastructure space. But we have to use all the tools in the toolbox to de-risk the situation, but then also to enhance value. And so what that means is using, this is going to sound crazy, blended hybrid finance innovation. So that's what I'm calling it now. And as a consultant, I can make stuff up. You know?
And then we need an acronym for that.
Yeah. So I'll give you a classic situation. Far too often, we get appointed to engagements for projects which are in the pre-development phase, where they don't even qualify for TA facilities. And there you need to have an innovative team that's willing to roll up their sleeves and de-risk the situation. And so that involves having a facility, a pre-TA facility available. And so we were working with one of our fund manager clients to help them to develop that value chain through their fund. And so now they've got a 4-tier process. So the initial part is about de-risking. Then it's about providing development funding. Then it's about providing construction equity. And then finally, you can go into credit funding. And through that innovative value chain, they've got I think they've got a 90% success rate now, up from about 20 to 30% prior to that. But not only using those innovative structures, in Africa, we've got amazing assets, natural, human capital, and we're resourceful. So I worked on a blue bond project in Ecuador. We were able to use the expansion of the marine protected area around the Galapagos Islands to do a debt restructure that reduced the cost of debt on $1.5 billion of debt to the Ecuadorian government by 2% per annum. And it eventually creates a pool of funding over $500 million that can be used for protecting that marine protected area, but also for generating commercial activity, so it can make commercial investments in the region. And so it can fund incubators into accelerator programs, to venture capitalists, to private equity, to eventually qualify for credit funding, you know. And so that's just a great example. And those types of transactions are on the way in Africa at that site. So there is a pipeline of investments in Africa that's going to be developed, I have no doubt.
So the blending is not happening as we typically think in a capital stack, right? It's happening horizontally depending on the project cycle.
I think, you know, look, it can happen both ways.
Yeah.
And that speaks to innovation, it speaks to flexibility. I always say to my clients, and I deal with investors of all types, I deal with fund managers, and I deal with portfolio companies and projects. And whoever we're speaking to, you know, what you want to do is you want to give yourself options, give yourself flexibility, and it ultimately creates more value in the whole equation. So if you're going into the market for debt funding, look at ways that you can de-risk your project. So in an affordable housing project in South Africa, we helped the project developer to reduce their cost of funding quite significantly by looking at the impact they were having and helping them to quantify that impact. And then we had to sell that impact to the funders. And they bought our story, we're good consultants, you know, and they bought the story, but we developed a financial model that proved that the impact was real, and it had carbon emissions reduction, it had social impact that could be quantified in rands and cents in that situation. And instead of getting, you know, any reduction in the cost of debt is fantastic, but the reduction in the risk of this project, which was created by actually having a happier tenant that is more likely to pay their rent on time and reduces the credit risk in the transaction for the lender. And ultimately it led to a 2% reduction in the cost of funding. Now that's quite significant. Most of the social and sustainability linked bonds, you're lucky to achieve a 25 basis point reduction.
So just on that point of cost of capital, I mean, I've spoken to a lot of developers in the energy space, mini grids, and that's what they complain about, is to say the margins are still so thin for them that getting the financing and addressing that cost of capital is an issue. Are you seeing the same in your markets, and how do we address that?
Yeah, sure. I think, you know, what we've seen is that you have to be able to demonstrate the climate story and the impact story to be able to attract a source of funding that is willing to reduce the capital cost and also share risk increasingly. And so that naturally begins to drive a climate alignment mindset in how projects are designed, selected, and ultimately executed. So we were able to actually develop a blended, at the capital structure level, funding program that allowed us to unlock financing. So we got FCDO to provide a subordinated debt for a program where we could provide senior debt guarantees for distributed renewable energy projects in rural communities to build out these isolated mini-grids at a cost of capital that was comparably affordable, blended to somewhere roughly around 9% compared to where market rates were. It was really on the back of the fact that we had to demonstrate the impact that kind of financing was bringing in terms of energy access to unserved, underserved communities, but ultimately the scalability of it, that over time it will become self-sustaining, and that creates an ongoing role with you know, with both the funders and also the developers to demonstrate sustainability and ability to scale. And Nigeria, obviously, is one of the countries with the highest energy deficit in the world. Over 85 million Nigerians don't have energy access. And it's estimated that we require somewhere around about $16 billion to address, to achieve universal energy access by 2030. And that will have significant impact in the communities that can be electrified. And so it's a scalable model, but importantly it's about making sure that the model is designed in a way that it can sustain itself over time.
I'm going to ask MAELIS and WAIRIMU, you're again working at the venture space. What do you see as the link with the capital markets?
Very good question. We actually had a session this morning about exit and liquidity challenges across the continent. So, I mean, obviously from where we sit, the journey to an IPO, like actually being able to leverage capital markets fully, it's quite far away, because we invest when a company has a product, a strong team, but they have maybe like a couple hundred customers, but we're really, again, like at the very early stage of that growth. But I do think working on really strengthening the role that capital markets could play in enabling then really that exit potential for these early ventures is key, something that we're thinking about, but we're also, frankly, from our perspective, thinking about other options. For example, how do we strengthen relationship with corporates for M&A? How do we think creatively about creating those relationships early so that could be also an exit? Because we haven't seen, as you know, a lot of IPOs as a journey for companies on the continent. And then also exits in other ways via secondaries, like for an early stage fund like ours. We actually run a quick survey with investors that are part of African VC group, and basically 38 to 40% of the investors that had exit via secondaries. So actually stimulating also that market with PE funds or growth stage funds, I think is also key. So we need to explore all options so that, as you were saying, the capital continuum is there for those companies to be successful, scale, and get to a point where they can eventually expand globally. Exactly, short-term and long-term.
Yeah, the long-term. Yeah. WAIRIMU?
So MAELIS has covered some of that. I'm going to answer that a little bit differently in terms of how we can get the startups to that path towards accessing more capital, towards accessing IPOs and exits. And one of the things that we found is that there is a lot of debt capital coming to the African continent, growth stage capital as well, private equity, but there's not enough venture capital that's willing to take that initial risk, and in fact, a whole lot of perceived risk, I would say. So being able to catalyze more venture capital and venture equity especially, because even when our companies are obtaining debt capital, there's always the question of, well, what's the equity portion, so that there's a bit of de-risking there. So I think encouraging more venture capital is going to be very important. And the other aspect of accessing the capital markets is being able to work with partners and convincing partners, especially when it comes to climate and social and economic impact, to have a higher risk appetite, because there's a lot, again, of money being held in pension funds. And last week we had a conversation with an advisor of pension funds based in Zurich, and they are working on advisory where their pension fund clients can invest in impact. But the whole question then came back to, okay, what are the returns, what's the level of risk, and what we're not sure is whether they can be able to invest. But I think there needs to be a bit more appetite in the capital markets, especially if we want to make a difference of impact in Africa, in aligning with everybody's climate commitments. Because you can make as many commitments as you want, but grant funding won't, not that it won't, but it won't be enough to get these companies to scale. Yeah.
Thank you. So I know we've got like 2 minutes left, so I'm going to ask each one of you to share with us what you would like the headlines to be of the Financial Times in 10 years' time. I'm going to start with you, Charles.
Put me on the spot, yeah. So in the FT, Africa
Yes.
solves the climate and biodiversity crisis, because I think the two go hand in hand, through innovative financial solutions. I believe that we have them in our ecosystem. I know we can do it. We've just got to stay glass half full and keep on finding the solutions. So I think the solution to the venture capital lack of VC funding, what about a listed VC fund of funds that takes advantage of carbon credits and grants and other incentives to help to mitigate some of the risks? We just got to be smart.
Fantastic. And you're going to be the head of that fund of funds. CHINUA.
Look, I think that Africa succeeds in mobilizing its domestic resources and strengthening its local capital markets to address climate action.
Fantastic.
That's great. For
And
me,
InfraCredit
so many
has led
headlines.
the way.
So many headlines. For me, it would be Africa creates at least 10 of the leading global companies that are tackling climate change today, enabling us to stay below 2 degrees of warming. And they're the leader.
Thank you.
Yeah, no, same here. Africa takes lion's share of global climate financing. That's what we want to achieve. That's what everybody is saying in COP27, heading to COP28. Let's see that. Let's Africa take the lion's share of private capital in climate financing globally.
Thank you. So I think just in conclusion of this amazing 2 days, we have to be bold and we can achieve those results. So thank you very much for being here, and let's thank our panelists for their amazing work and their contribution.